In this session, we're going to talk about asset revaluation, what it is, why it happens, and how it works in practice. Forget accounting standards for a moment. Let's focus on the idea first. Asset revaluation means updating the value of a long-term asset to reflect what it's worth today rather than what it cost in the past. Over time, the value of assets can change. Buildings go up or down in value. Equipment becomes outdated. Markets change. Revaluation usually applies to non-current assets which the business uses over a long period. Typical examples include land, buildings, and plant and equipment. Asset values can move in two directions, up or down. An increase in value is called an upward revaluation. A decrease in value is often referred to as a downward revaluation or an impairment. What's really happening in upward revaluation? Let's say a building was bought years ago and is now worth much more. The business hasn't sold the building, no cash has been received. So even though the asset is more valuable, the gain is unrealized. That's why upward revaluations are not treated like normal income. Instead, the increase is shown separately, usually in equity, not a trading profit. Let's see how upward revaluation works in practice. Business bought a building years ago for $400,000. Accumulated depreciation to date is $100,000. Carrying amount or net book value before revaluation is $400,000 minus $100,000 equals $300,000. An independent valuer now says the building is worth $500,000. Step 1. We work out the revaluation increase. Current carrying amount is $300,000, revalued amount is $500,000, upward revaluation is $200,000. Step 2. What has not happened? The building has not been sold, no cash has come in, no customer transaction has occurred. So this $200,000 is an unrealized gain. It exists only on paper. Step 3. Because it's unrealized, the gain does not go to profit or loss. Journal entry is debit property, plant and equipment $200,000 and credit revaluation surplus. Step 4. How the accounts look after revaluation. In the balance sheet, non-current asset building is $500,000, equity revaluation surplus is $200,000, profit for the year is unchanged. The increase is not income, it sits in equity, not profit. It's labelled separately as a revaluation surplus, so accounting keeps it out of profit to avoid overstating performance. An upward revaluation increases the asset's carrying amount, but because the gain is unrealized, it is recognized in equity as a revaluation surplus rather than in profit or loss.